In this lesson, we're going to discuss the Affordable Care Act and the tax provisions associated with that on the tax return. So after completing this lesson, you should be able to determine what qualifies as minimum essential coverage, determine if a taxpayer qualifies for a health coverage exemption, determine if a taxpayer is eligible for premium tax credits, determine who must make a shared responsibility payment, and recognize tax forms that show evidence of health coverage. So we've alluded to the Affordable Care Act a number of times throughout Unit 1, 2, and 3 trainings. And we're now going to talk about the various tax provisions associated with that. So first of all, let's start out by talking about what the Affordable Care Act is. The Affordable Care Act is a piece of legislation that was passed a couple of years ago that requires the federal and state governments, insurers, employers, and individuals to share responsibility for improving the quality and availability of health insurance coverage in the United States. So the Affordable Care Act reforms the existing health insurance market by prohibiting insurers from denying coverage or charging higher premiums because of an individual's pre-existing conditions. So a lot of our taxpayers will have benefited from the Affordable Care Act, many of whom were not able to get insurance because of those reasons. And then finally, the Affordable Care Act also created what's called the Health Insurance Marketplace, also known as healthcare.gov. I will mostly refer to it as healthcare.gov throughout this lesson. A lot of states created their own state health insurance marketplaces as well. Alabama, South Carolina, Florida, and Tennessee are not one of those states. They all rely on the federal health insurance marketplace. So we will be talking mostly about healthcare.gov. So healthcare.gov is where taxpayers find information about health insurance options. It's where they can purchase health insurance, and it's where they can obtain help to pay premiums and out-of-pocket costs if they are eligible. So those help in paying premiums comes in the form of a new refundable tax credit that was created called the Premium Tax Credit and is available through the marketplace and helps eligible taxpayers pay for coverage. Let's talk about the shared responsibility provision of the Affordable Care Act. So under this provision, the Affordable Care Act is going to require individuals to have either qualifying health coverage, which is going to be called minimum essential coverage is what I'll refer to it as from here on out, for each month of the year, or they must qualify for a health coverage exemption if they do not have minimum essential coverage for each month of the year. Or finally, if they do not qualify for a coverage exemption or do not have minimum essential coverage, they must make a shared responsibility payment when filing their federal income tax returns. This last part, this is essentially a tax penalty for not having coverage. And unfortunately, a number of our taxpayers will probably fall into this third category because they will not have had coverage and they won't qualify for an exemption. Well, let's start by talking about what is minimum essential coverage. So minimum essential coverage is essentially health coverage that satisfies the individual shared responsibility requirement. And most health insurance is going to be considered MEC. We'll discuss specific types here in just a moment. However, note that no proof of coverage is going to be needed. Oral statements from the taxpayers are acceptable unless normal due diligence in the course of the interview with the taxpayer leads you to believe that the taxpayer's statement is incorrect about their coverage or lack thereof.
On page 3 of the intake interview form, a volunteer will interview the taxpayers about what kind of health insurance they and their family have. They will note the specific type of insurance as well as the number of months they were covered during the tax year, making notes about any coverage exemptions that might apply, which we'll talk about in a moment. Volunteers should check that the taxpayer's health insurance qualifies as MEC by consulting the Pub 4012 and the ACA tab.
So who needs minimum essential coverage? Essentially, everybody that's on the tax return needs to have minimum essential coverage, or if they don't have minimum essential coverage, they need to have a coverage exemption in order to avoid the shared responsibility payment. Now, the taxpayer is going to be responsible for the insurance, the coverage exemption, or this individual shared responsibility payment of each person on the return. So the spouse, dependents, the taxpayer is going to be responsible for all of those people on their return if they don't have insurance. How many months do taxpayers need to have MEC? Everyone needs to have MEC for every month of the year. However, it is important to note that a person is considered covered for the whole month if they had coverage for at least one day of that month. So if they obtained coverage on July 31st and they did not have it the previous 30 days, they are still considered to have been covered for the entire month of July. Also, a person who was born or died during the year is only required to have coverage for every full month that they were alive.
So if a child was born on November 20th of the tax year, they would only be required to have coverage in December of the tax year, the full month alive.
So let's look at some different types of categories of minimum essential coverage. First, we have employer-sponsored coverage, and that includes group health insurance plans for employees under a governmental plan or a grandfathered health plan. A grandfathered health plan is essentially a plan that is not MEC, but was sufficient before the Affordable Care Act was enacted, so it's been grandfathered in. It also includes a self-insured health plan that is provided by employers for employees, as well as COBRA coverage, which is coverage that can be purchased by a taxpayer immediately after leaving or getting laid off from a job that continues previous coverage, but usually, unfortunately, at a higher cost. But it does count as minimum essential coverage. And then finally, retiree coverage also falls into this category. Next, we have individual health coverage, and that includes health insurance purchased directly from an insurance company, health insurance purchased through the marketplace, through healthcare.gov, and finally, health insurance through a student health plan also counts as minimum essential coverage. Our third category, government-sponsored programs. This includes coverage from Medicare Part A, Medicare Advantage plans, and most Medicaid coverage. So note that some Medicaid plans only provide limited coverage that exclude hospital, doctor, and other basic services. This is not considered MEC, but we'll come and talk about that a little bit more in just a moment.
Finally, we have Children's Health Insurance Program, which is CHIP federally. In Alabama, it is called All Kids. In Florida, it is called Kid Care. In South Carolina, it is called Healthy Connections. And in Tennessee, it is called Cover Kids, but CHIP federally.
We also have most TRICARE coverage. TRICARE coverage is primarily for active duty and retired military personnel and families. Like Medicaid, limited coverage from TRICARE does not qualify as MEC, but again, we'll talk about that in just a moment. We also have coverage from the Department of Veteran Affairs, coverage for Peace Corps volunteers, as well as Department of Defense Not Appropriated Fund Health Benefits Program and Refugee Medical Assistance. So any of these government-sponsored programs will count as minimum essential coverage. And then finally, some healthcare plans don't fit into the other categories, but they do qualify for minimum essential coverage, such as certain foreign coverage and certain coverage for business owners. Now, the publication 4012 will have a full list of what does count as minimum essential coverage and what does not count as minimum essential coverage, but let's actually talk now about some that specifically do not qualify as minimum essential coverage. So there are some health plans that may provide limited benefits, but they don't qualify as minimum essential coverage. That's going to include coverage that consists solely of accepted benefits, such as standalone dental or vision insurance, disability income insurance, and workers' comp insurance. So if a taxpayer just has vision insurance, they don't have any other type of insurance, that unfortunately does not qualify as minimum essential coverage. Also, we have Medicaid or TRICARE that only provides specific medical services, such as family planning or pregnancy-related services, etc. Any of those things, that also does not count as minimum essential coverage. And then finally, most AmeriCorps and AfterCorps coverage don't count as MEC as well, although you as a core member at Impact America, you are covered. Our plan does count as minimum essential coverage, but a lot of AmeriCorps plans do not count as minimum essential coverage. Let's talk about some tax forms that show evidence of health coverage. So there's a couple of tax forms you're already very familiar with that show evidence of minimum essential coverage. We have the form SSA 1099, which reports Social Security benefits received, and it reports Part A Medicare premiums. And also we have the form W-2, which reports wages and salaries from a job, and it can report employer-sponsored health coverage in box 12 using code DD. We have some brand new forms that you've never seen, however. We have the Form 1095A, which is a health insurance marketplace statement. This is going to be issued by healthcare.gov. Now, we're going to discuss this form in more detail when we start talking about the premium tax credit. But just so you know, every taxpayer who purchased health insurance from healthcare.gov is going to receive this Form 1095A. Next, we have the Form 1095B. This is going to be issued by Medicaid, Medicare, insurers, and others offering coverage. So a lot of taxpayers will receive this year, and it will report their health coverage. You will either see something here in Part 2 for employer-sponsored coverage or Part 3 for issuer or other coverage provider. So that could be from Medicaid or Medicare. And then it will also show the covered individuals and for what months they were covered. Finally, we have Form 1095C. This is going to be issued only by large employers. That would be 50 or more employees. So some taxpayers may bring this in. This form is going to show evidence of health coverage. Not every taxpayer who has employee-sponsored coverage will receive this form, however. They should only be receiving it if they're part of a company that has 50 or more employees. So a taxpayer may bring in this form to show evidence of their coverage for the year. Let's talk now about health coverage exemptions. Health coverage exemptions are reasons for not having health insurance that avoids payment of the individual shared responsibility payment. Anyone without insurance coverage for any month of the year should be screened for exemption eligibility. So a taxpayer may have had it for 11 months of the year, they just didn't have it for 1 month. At that point, we need to screen them for that 1 month to see if they qualify for an exemption to avoid this shared responsibility payment. So determining if a taxpayer qualifies for an exemption can be tricky. So what we're going to do is you're going to start by finding out if anyone on the tax return already has an exemption in hand from the marketplace from healthcare.gov. So these are exemptions that the taxpayer had to apply for through healthcare.gov, and if they qualified, they received an exemption certificate number from healthcare.gov. So this is going to be a 6 or 7 alphanumeric code. It'll just be printed on a sheet of paper. A taxpayer will bring that in, and you can type in the code in a place on the return, and it will give them that exemption for the month. We're going to discuss exactly what these exemptions might include in just a moment. If the taxpayer doesn't have an exemption from the marketplace, the next choice is to check to see if a taxpayer's household or gross income is under the filing threshold for their filing status. If they are, then everyone on the tax return is exempt from the coverage requirement, and there is no need to consider further exemptions. Now, there is a difference between household and gross income. We're going to talk about what that is here in a minute, so just hold on to that for now. However, if the family is not under the filing threshold and does not have a marketplace granted exemption, you should next check to see if any individual qualifies for an exemption that can be claimed directly on the tax return. Now, this is going to be something that you determine by talking to the taxpayer and using your resources and also looking at their level of income, other various elements that could go into determining if a taxpayer qualifies for this exemption. If they do qualify for one of these exemptions, you're just going to enter in the specific exemption code on the appropriate place in the tax return, and they will be covered for those months and can avoid the shared responsibility payment. Finally, if any uninsured individual does not qualify for an exemption to be claimed on the tax return, you should talk to the taxpayer and see if they may qualify for an exemption granted by the marketplace healthcare.gov. If yes, then we can help them apply for an exemption online, and we can enter pending on the tax return. So we can actually go to the marketplace, we can help them apply for this exemption, and then if they receive it, then there's nothing more that needs to be done. If they get denied for the exemption, what they'll need to do is come back in and amend their return to go ahead and add the shared responsibility payment. So let's go ahead and talk about some exemptions that are granted by healthcare.gov and what those are. So these are specifically called hardship exemptions. Many of the following have very specific guidelines before they can be claimed, which is why it can sometimes be difficult to help them apply for these, but if you think they might apply, it might be worth it to go ahead and sit down with them and help them do this. So first we have homelessness, eviction in the last 6 months, or facing eviction or foreclosure. If a taxpayer received a utility shutoff notice, issues related to domestic violence, the recent death of a close family member, disaster that resulted in significant property damage, bankruptcy in the last 6 months, debt from medical expense in the last 24 months, high expense caring for ill, disabled, or aging relatives. There are some other exemptions that you can find in your publication 4012 or on healthcare.gov. If it seems that your taxpayer may qualify for one of these hardship exemptions granted from healthcare.gov, we might be able to help them apply online. So if you have questions about that, you're of course welcome to call a supervisor and help you walk through that. But I think it would be worth it to check if a taxpayer doesn't have any other options for avoiding the shared responsibility payment. And let's talk now about the household gross income below the filing threshold exemption. So let's talk about the difference between household and gross income. First, we have household income. If the modified adjusted gross income of the entire household is below the filing threshold, everyone on the return is eligible for this exemption. So household income is modified adjusted gross income. That is just your regular AGI plus tax-exempt interest and certain foreign excluded income. We should never see any foreign excluded income at the site. So essentially, it's just AGI plus tax-exempt interest. For most taxpayers, it'll just be their AGI. However, we also do have to include a dependent's income when determining household income if that dependent is required to file a tax return. So you can see the Filing Basics tab in your publication 4012 to determine if a dependent is required to file a tax return. Note that just because a dependent may file a return, it doesn't mean that they are required to. They might just be filing it to get a refund back because they didn't know any tax liability or anything like that. But check your Pub 4012 to see the conditions in which they would be required to file a return. If they were required to file a return, you've got to add that to household income in order to determine if they are below the filing threshold. Now, gross income, which is all of the income received in the form of money, goods, property, and services that is not exempt from tax, including taxable Social Security benefits. If the gross income is below the filing threshold, then everyone on the return is eligible for this exemption. So for gross income, you do not need to include dependents' income when determining gross income, even if they do have a filing requirement. So if they do have a filing requirement, you do have to include it for household income. You do not when you're talking about gross income. So again, you can see the Filing Basics tab of the Publication 4012 to find out what the filing thresholds are. In the tax software, it will show you the filing threshold, and it'll show you the estimated gross income and the household income, and a place for you to enter dependents' income as well. And so you can compare to see if they are below it or not. Finally, let's talk about the exemptions that can be claimed directly on the tax return simply by inputting a letter code on the return. So there are a number of ones that we're going to talk about. First, we have unaffordable insurance, which is the cost of coverage exceeds 8% of household income. We can use code A on the return. We're going to talk more about that one in a moment, so we'll come back to that. Next, we have the short coverage gap that is less than 3 months with code B. We're going to talk more about that one as well. Certain non-citizens and U.S. citizens living abroad with code C. Members of a healthcare sharing ministry, that's code D. This is a type of religious exemption typically. You can see a description of it in your publication 4012. It's unlikely that we'll see many taxpayers that qualify for this exemption, but it is possible. Next, we have federally recognized Indian tribe or eligible for services through the Indian Health Service. So we have a taxpayer who is part of an Indian tribe, then they can qualify for an exemption on the return using code E. If a taxpayer was incarcerated for the year, any month that they were incarcerated, we can use code F for those months. Their health care is being provided by the state or federal government during that time. Next, we have the aggregate cost of employer insurance is unaffordable. We'll talk about that one in more detail in our group training. We have a resident of a state that did not expand Medicaid. We can use code G for both this one and the last one. Aggregate cost of employer insurance is unaffordable. And then finally, member of the tax household was born, adopted, or died during the year. We'll use code H for that, for those months that applies to. So let's talk about a few of these in more detail. First, we have resident of a state that did not expand Medicaid.
That is referring to individuals who resided at any time during the tax year in a state that did not expand Medicaid and had household income below 138% of the federal poverty line. Many taxpayers will be eligible to claim this exemption because their state did not expand Medicaid, and this will be common at our tax sites. So when the Affordable Care Act gave states the option to expand Medicaid, the intention was to cover taxpayers who did not make enough money to qualify for subsidies through the premium tax credit, but who made too much money to qualify for their state's previous Medicaid threshold. So if a taxpayer's income is between 100% and 400% of the federal poverty line, they qualify to purchase health insurance through the marketplace and have it subsidized through the premium tax credit. However, if they live in a state that expanded Medicaid, taxpayers below 138% of the federal poverty line can receive Medicaid. Now, taxpayers who live in a state that did not expand Medicaid do not receive this benefit. In fact, some taxpayers who are below 100% of the federal poverty line don't qualify for their state's Medicaid, since Medicaid eligibility in those states is not based on income alone. So taxpayers below 100% of the federal poverty line also do not qualify for subsidies through the premium tax credit. Thus, a taxpayer who is below 138% in a state that did not expand Medicaid can qualify for this exemption. And this applies to Alabama, Florida, Mississippi, South Carolina, and Tennessee. If taxpayers live in any of these states that did not expand Medicaid, we'll be able to screen them for this exemption and apply it directly to the tax return.
Next, we have short coverage gap. Now, a short coverage gap is going to be 1 or 2 months. Now, note that if a taxpayer was uninsured in January of the tax year, you have to ask them if they had coverage in December of the previous year. If the gap going back to a previous year is longer than 2 months, then this exemption does not apply. So if a taxpayer did not have coverage for November and December of the year before the tax year, and they also didn't have it in January, they cannot use a short coverage gap for that month of January, even if they did get coverage in February, because their gap was longer than 2 months. However, if a taxpayer was uninsured in December of the tax year and they are still not insured, so they lost their insurance in November, they didn't have it in December, they're coming to you in March to have their return prepared, so they haven't had insurance in January or February. As far as the tax year goes, you can give them the short coverage gap for December, even though they have been uninsured for longer than 2 months. But the next tax year, they won't be able to claim it because they will have had a gap for longer than 2 months total. Now, this one, unaffordable insurance, the cost of coverage exceeds 8% of household income. This is a lot more complicated than it appears. So you've got to start by determining household income and then determining the lowest cost premium available to each person in the household. And that's going to come either from the cost of employer-sponsored insurance if it was available. If it wasn't available, then it's going to come from the lowest cost bronze plan, and that is just going to be what they can get from healthcare.gov. That's what the bronze plan is referring to. After premium tax credits, the cost of that total. So if the cost of those plans were more than 8% of household income, then they could qualify for this one.
We have a calculating spreadsheet available to aid you with screening for this exemption, but it is always best practice to call a supervisor for assistance.
This citizens living abroad and certain non-citizens, this is going to apply to individuals who are not U.S. citizens, nationals, or lawfully present, i.e. undocumented immigrants, as well as some other citizens living outside of the United States. In that case, the taxpayer would not have been eligible for purchase of insurance through healthcare.gov and thus would not have been eligible for premium tax credits. So they are exempt from this requirement and can use code C on the return. And finally, we have this member of tax household born, adopted, or died during the year exemption. You can use code H for this. The coverage requirement applies for full months alive or adopted. So what this exemption does is this covers the other months of the year when coverage was not required. So example, before birth or after death. So if a taxpayer passed away in November of the tax year,
then they were not required to have coverage for November or December. If they had coverage during any part of November before they passed away, then you would only need to claim the exemption for December. Code H is a little bit complicated for tax households with more than one person because this coverage exemption must only be applied under very certain conditions. For instance, if the entire household had MEC all 12 months and a deceased taxpayer did not have coverage during the months after death, Code H would not need to be applied, and you can select that everyone in the tax household had MEC for all 12 months.
Let's talk now about the premium tax credit. So a premium tax credit lowers the cost of health insurance coverage purchased from healthcare.gov. Premium tax credits can either be taken in advance, meaning that the payment is going to be forwarded directly to the insured to reduce monthly premiums, or it can be taken on the tax return, which means the payment is going to be claimed as a lump sum when filing the return at the end of the year. Now, advance payments from the premium tax credit are made based on the taxpayer's expected household income for the year during the application process. So when they are signing up, they're in the enrollment process on healthcare.gov, they will be required to project how much income they think they're going to make during the year, and then the premium tax credit will calculate based upon that expected income. The actual premium tax credit will be claimed on the tax return. And if a taxpayer received excess payments of the advanced premium tax credit, maybe because they projected that their income was going to be a certain level, but it ended up being higher, they may be required to pay back some of the premium tax credit, or they may be required to pay all of it back, depending on how much higher their income actually was. So to receive a premium tax credit, a person must enroll in a plan through healthcare.gov. That's important. It's not available to those who did not enroll through healthcare.gov or through state exchanges. They must have income between 100 and 400% of the federal poverty line. They must have an eligible filing status, and they must be ineligible for other minimum essential coverage. So if they can receive coverage through their employer, they are not eligible for a premium tax credit through the marketplace. So a note about the third requirement there, have an eligible filing status. The premium tax credit cannot be claimed by a person who is married filing separately. So this is another reason why we try to avoid filing a taxpayer as married filing separately, if at all possible. However, there are exceptions for abused or abandoned spouses. Domestic abuse, if the taxpayer lives apart from the spouse and is unable to file a joint return because of domestic abuse, or if the taxpayer lives apart from the spouse and is unable to locate the spouse after using due diligence, then the taxpayer can still claim the premium tax credit in these cases. This is an exception to this rule, and it can only be used for a maximum of 3 consecutive years. Now, when it comes to this exception, the taxpayer does not have to produce proof to the tax preparer, but as with other claims on the tax return, the IRS could ask for verifying documents later, so they should have it if possible, but we don't actually have to see it in order to still give them the premium tax credit on the return. If neither of those exceptions apply, though, a person who is married filing separately is not eligible for the premium tax credit. Also, the premium tax credit cannot be claimed on a dependent's return. Whoever claims an individual's exemption is going to be the one that needs to claim their premium tax credit. So where do we start with premium tax credits? First, only taxpayers who purchased health insurance from healthcare.gov potentially qualify for the PTC. So if they did purchase from healthcare.gov, we're going to complete a Form 8962 in our tax software. If they did not purchase from healthcare.gov, then you do not need to complete this form because they do not qualify for the premium tax credit. Next, we're going to make sure that the taxpayer has Form 1095-A, Health Insurance Marketplace Statement. You're going to have to use this form to help you complete the tax return. So if the taxpayers did not bring this form, then they're going to need to call the Marketplace call center or check their account on healthcare.gov, or they just need to wait until they get it sent in the mail. They may come to our site early and just not have received it, but we do actually have to see this form in order to complete the return. If they do have this form, we're going to use it to help us complete Form 8962. All members of the household on a single policy are going to be on one Form 1095A, but they may have multiple 1095As if they purchase multiple policies or they made changes mid-year. That's fine. We'll take all the 1095As, we'll add them up, and we'll include them on one 8962. So here's our Form 1095A Health Insurance Marketplace Statement. We're going to be primarily interested in Part 3. That's the part that we're going to be putting on the tax return. However, Part 1 is showing recipient information, and it'll show the policy start and termination date. And then Part 2 will show who is covered by this policy, so what members of the household are covered by the policy. And then finally, Part 3 is going to show coverage information for each month of the year. So we have here Part A, Column A, monthly enrollment premiums. This is going to include the actual premium paid plus advanced payments of the premium tax credit. This will not have certain extra benefits such as dental, but it's not really important for our purposes. This is going to show the full amount of the premium. Column B is going to show the monthly second lowest cost silver plan premium. This is the benchmark plan that helps establish the premium tax credit amount. It might be incorrect if no premium tax credit, advanced premium tax credit was paid, or if a change in the circumstances was not reported. It's possible this could be wrong. In the first tax year that this was available, the IRS asked us to check this on the healthcare.gov website because a number of them went out incorrectly. It's possible that could happen again. Luckily, there is a tool available online that we'll show you how to use in order to figure out what this is. But most of the time, this will be right. We'll just need to type it in exactly as it is. And then column C finally is monthly advanced payment of the premium tax credit. This might be blank if they did not receive any advance payments, but if they did, it will be listed in this column. So there are a couple of situations in which a return will be out of scope for us when it comes to the premium tax credit. So most tax returns with Forms 1095A and premium tax credit 8962 are in scope for volunteers certified as advanced. So that would be all of you as core members, you're all going to be certified as advanced. Almost all of them are in scope. However, a couple of advanced reconciliation scenarios are out of scope for our VITA sites. And that is going to be shared policy allocations in Part 4 and the alternative marriage calculation in Part 5. So I'm just going to briefly mention what these are so you are aware of why a taxpayer might need to do this, but it is going to be out of scope. So let's talk about the alternative marriage calculation first. So because the advanced premium tax credit is applied based on a projection of income, as we mentioned earlier, marriage can greatly affect the calculation and might lead to a significant repayment. So we have a taxpayer who projected their own household income for the year, but then they got married and then they added their spouse's household income to that. That's going to change their projected household income. They might have to repay a significant amount of that since it's adding more people to the household. The alternative calculation can lead to a higher allowable premium tax credit than the traditional calculation, which means they could ideally have a lower repayment. However, that's, again, out of scope for us. Let's look at the minimum requirements to use the alternative marriage calculation. You can look at this, and if they do not even meet these minimum requirements, then you know that they would not qualify for this calculation, so you can go ahead and complete it as normal. But the minimum requirements are that they were unmarried at the beginning of the tax year, they were married by the last day of the tax year, they are filing a joint return, one person was enrolled in a marketplace plan prior to marriage, and a premium tax credit was paid in the tax year. If all of those conditions apply, they might want to use this alternative marriage calculation. So how to deal with this? If the taxpayer got married during the year, go ahead and prepare the return as normal by filling out the 8962, which we'll talk about how to do that in group training. If the taxpayers got a net premium tax credit, which means that maybe they didn't receive enough of the premium tax credit actually, then that's fine. The return will be in scope. There's no need to do this alternative marriage calculation because they're not going to have to repay any of it back. But if the taxpayers are required to repay back a portion of this premium tax credit, they may benefit from doing this alternative calculation. At that point, you can let them know that there is an alternative calculation that is out of scope for us, but it may result in a lower repayment if used. The taxpayer will then have to decide how to proceed. You can kind of help them figure this out and use your judgment. If the repayment amount isn't that large, it's probably not worth doing this, and you can just go ahead and do it as normal. If it's a really large amount of money that they're owing, though, it might be beneficial for them to go to a paid preparer to help lower that, possibly. Let's talk now about the shared policy allocation. In general, a shared policy allocation occurs when a marketplace policy covers someone in the taxpayer's family and someone not in the taxpayer's family who is being claimed on someone else's return. So the return is going to be out of scope if the 1095-A includes someone who is not on the tax return. So for example, a taxpayer and their spouse purchased insurance through the marketplace. However, they got divorced, so they're no longer their spouse. They're no longer on the return, or they're married filing separately. That's going to be out of scope for us because there will be a shared policy allocation required. Or a child who becomes a non-dependent. So if a child was a dependent when it started, but now they're a non-dependent and they need to file their own return, a shared policy allocation must also occur at this point. Also, a person who is on the return but was enrolled in healthcare.gov with another taxpayer. If you've got a custody situation in which one taxpayer paid for the health insurance but they are on the other taxpayer's tax return, then that would result in a shared policy allocation as well. So the return is actually going to be in scope for us if there is no healthcare.gov coverage. So this policy provision doesn't matter if there's no premium tax credits involved. Divorce or separation, but everyone on the policy is on one taxpayer's return and no one on the policy is on the other taxpayer's return. It would be in scope there as well. And finally, a shifting enrollee situation in which the person is enrolled by one taxpayer, claimed by the other, but that dependent is the only person on the policy. So, for instance, you have a dependent that's on a policy that was enrolled by an ex-spouse, however, they're being claimed on the other spouse's return. That's fine as long as the dependent is the only person on the policy. That 1095-A can be entered appropriately on that taxpayer's return. Let's talk lastly here about the shared responsibility payment. So a shared responsibility payment for a taxpayer, spouse, or dependent who is uninsured and not eligible for an exemption will be calculated on the return. So you should make the taxpayer aware of this shared responsibility payment. A lot of this is going to happen automatically on the tax return. You're going to have to choose which months that they did not have coverage and also weren't eligible for a health coverage exemption, and then the tax software is going to automatically calculate the shared responsibility payment. But you need to make the taxpayer aware of how much that shared responsibility payment is, because this amount is going to continue to increase in the coming years. So if a taxpayer did not have insurance, we need to refer them to a healthcare assister if possible. We're going to be trying to come up with various resources in different states for how we can help taxpayers who did not have insurance. Medicaid and CHIP are always open for enrollment, so taxpayers can always go to a healthcare assister for that. The healthcare.gov marketplace enrollment typically only runs from November to January. After the deadline of the enrollment, after open enrollment is closed, a taxpayer can only purchase insurance through the marketplace under certain circumstances, usually because of marriage or having a baby, losing other insurance, or moving. So taxpayers need to be aware of their options, and we need to help them, if possible, to get health care so that the taxpayer does not have to pay that shared responsibility payment in the coming tax years. So that includes our lesson about the Affordable Care Act tax provisions. You should now be able to determine what qualifies as minimum essential coverage, determine if a taxpayer qualifies for a health coverage exemption, determine if a taxpayer is eligible for premium tax credits, determine who must make a shared responsibility payment, and finally recognize tax forms that show evidence of health coverage.